Hello everyone, I'm Ethan Ng from Class FA, and today I will be doing a video reflection for my ICA 1 for Digital Banking and Fintech module. I will be covering first what a digital bank is and why MAS decided to grant 5 digital banking licenses. I will then proceed to explain what problems it solves, how a sustainable digital banking model is fit to address the problems, what a sustainable digital banking model is, the implications without the model, the advantages and disadvantages of digital banking before explaining what the licenses mean for the Singapore financial sector in relation to Hong Kong's financial sector, and why MAS does not want to have value-destructive competition. I will be explaining my points after research from different websites and news articles such as the MAS website and Today Online. I will also be providing examples to support my claims. So recently, MAS came to the decision to grant 5 digital banking licenses to potential applicants. But before we go into the details of that, we must first understand what digital banking is. Digital banking is when financial services are provided online over the internet without the need of a physical banking branch. These banks embrace Fintech to provide financial services to their customers and undergo a complete digital transformation from the front to the back for both their customers and employees. An example would be neobanks who do not have a financial license but work with other financial institutions to provide bank license services. So, what does this decision entail? First of all, according to MAS, they stated the reason for granting the licenses is to ensure that the banking industry remains vibrant, resilient, and competitive while adding diversity to the banking system. This can also allow for collaborations between commercial and digital banks. With the license, 2 banks can become digital full banks while 3 banks can become digital wholesale banks. It could also be a reaction to Hong Kong releasing its 8 digital banking licenses as Singapore and Hong Kong challenges each other for the role of Asia's Fintech center. When digital full banks enter the market, there will first be restricted digital full banks with deposit caps, where the banks can only accept individual deposits capped at $75,000 and aggregate deposits capped at $50 million. The banks will also only be allowed to offer simple investment and credit products and not complex financial instruments such as structured notes. But with such restrictions to their activities, digital full banks will have a lower minimum payout capital of $15 million. In time, after meeting all the relevant milestones and assessed to provide no further concerns to MAS, the digital full bank will no longer be restricted and can be a full functioning digital full bank with payout capital of $1.5 billion. For digital wholesale banks, they have a minimum payout capital of $100 million and will not be allowed to take Singaporean dollar deposits except for individual deposits of at least $250,000. They must be locally incorporated and must present a viable exit plan when applying, and all this is according to MAS themselves. MAS also wants to solve certain problems as well, such as the lack of competition. By introducing tech companies into the banking scene, it will provide incumbent banks such as DBS and OCBC the competition to improve their online financial services, rather than remaining complacent with their market dominance and run the risk of their margin shrinking in the long run. Another would be to serve the underbanked segments. The current incumbent banks are unwilling to serve the underbanked segments because of the high credit risk and low profitability, and the potential inaccessibility to banks some people may experience cause the underbanked segments to be that way. To solve the high credit risk issue, digital banks have technology such as API to tap onto their data to make better decisions and understand the amount of risk they are willing to take. To solve the potential inaccessibility, digital banks do not have a physical branch as they operate online. Due to the lower overhead costs and operating expenses, these banks can provide higher interest rates to their customers for their deposits with personalized services which are cheaper as well, which solves the issue of inaccessibility to banks. MAS will also allow applicants to make a case to them as to why they deserve the license and then assess their value proposition in terms of meeting unbanked needs. Digital full banks will cater to retail customers, while digital wholesale banks will cater to SME and medium-sized enterprises and other non-retail segments according to Today Online. MAS has also done its part in trying to solve the problems. It stated that the organization or its parent company that applies for the digital banking license must demonstrate a sustainable digital banking model. Why would banks need to show that they have a sustainable digital banking model? Well, having a sustainable digital banking model would be very suitable in solving the issue of lack of competition due to them being appealing to customers, and since it is sustainable, they will have practices that are profitable as well, which allows them to continue expanding and growing for years to come. In looking at the digital banks, if they expand to the size of a DBS and OCBC for example, not only will the digital banks have a following due to them catering to the underbanked when the incumbent banks were not catering to them, more and more people will be curious about the rising digital banks and may want to try it out as well. This will continue to allow digital banks to continue expanding and could provide incumbent banks the motivation and competition required to improve on their innovation and products and services digitally to allow themselves to try and retain their market dominance within Singapore, and thus improving the banking sector within Singapore. In terms of the underbanked issue, with the banks being able to continue for years to come, the underbanked segments will not have to worry about not having a bank to go to and can grow with the digital bank in the future. So now you must be wondering, what exactly does sustainable digital banking business model mean? According to IBM, a bank with a sustainable digital banking model will be able to optimize its customer interactions, process, products and data around digital technology, which makes them very appealing to customers on the front end and digitally efficient on the back end. This is done by excelling at providing digital channels and engaging customers personally when needed. These banks use these to lower the cost of serving and improve their higher touch services. An example from IBM is USAA that does not have physical financial branches but gives banking advice to customers in financial centers. Another will be Live Oak Bank, who similarly operates without physical branches but sends their bankers on private jets to meet their clients to close a loan. This kind of bank requires optimization in interactions, where the bank understands when to apply a personal touch and when to use digital channels, optimized products that can be purchased and serviced easily on digital channels, optimized insights where bank uses customer insights to deliver the accurate product at the accurate timing either personally or through digital channels, optimized processes to decrease the cost of operating, such as creating a paperless environment by digitizing signatures and forms, which will create a digitally optimized bank. However, there are implications if a bank does not have such a model. Without it, banks could engage in practices that are considered unsustainable, and examples include the universal banking model in that it requires the bank to manufacture and distribute all of its products, which is unsustainable, or the banks investing in an industry that leaves them vulnerable and exposed to risks in the next 15 years. Furthermore, since clients would judge a bank based on how sustainable it is, if the bank does not have a sustainable digital banking model, customers will be less trusting towards the banks, which decreases the bank's customer acquisition rate. This could see a lower in their profit margins and thus causing them to shut down in the long run if they experience net losses. Hearing about what digital banking is, we should now look at the pros and cons of digital banking to both the banks and their clients. For banks turning digital, the advantage is that they can lower their operating costs through fewer errors and lesser physical branches, with lesser staff required because of it. This could cut costs of between 20 to 40%, which increases profits for banks. The disadvantage, however, is in the cyber attacks, which is one of the greatest problems that they face because of the large number of data they hold for each individual. In the event of a data breach, it will not only lead to the loss of public trust but also create customer insecurity. Additionally, recovering data after cyber attack is a painful process as it is very time consuming and stressful. Not to mention, as time passes on, more banks are open to keeping their data on the cloud, which means that their banks are more exposed to cyber attacks and a higher threat of their customer data leaking. From the perspective of a client, an advantage of going digital is that it will make things very convenient for them as they can easily transfer their funds and make payments to anywhere around the world that they want to. They will also no longer have to stand in queue to make payments for it to buy products as they can use digital financial services to pay for it. However, a disadvantage is that security is a major risk as unauthorized transactions may occur, especially when people on the internet manage to hack into a customer's personal account and use it to buy items for their own self-use. Now that we know everything that we need to know about digital banking, we should take note of how the issuance is going to affect the financial sector. In the near future, it does not seem like the big local banks will be too affected by the release of the licenses, as they have already invested a lot in their digital offerings. However, more jobs will be opened up through the opening of the new digital banks, which improves the financial ecosystem by accepting new talents. This will also reduce the number of jobless people around, improving Singapore's economy as a whole, and while serving the underbanked segments as well, through MAS's expectations. In relation to Hong Kong released 8 digital banking licenses as well, and according to HKMA's Chief Executive Norman Chan Teck Lam, the launch of virtual banks in Hong Kong, a key component of the Smart Banking Initiative, will certainly facilitate financial innovation, enhance customer experience, and financial inclusion. The words financial innovation and enhanced customer experience tells me that the license was released as motivation for the local banks in Hong Kong, such as HSBC and Standard Chartered, to improve their digital offerings, while financial inclusion means that HKMA wants these digital banks to be able to cater to all people in Hong Kong. including the underbanked and the unbanked segments of Hong Kong. For both countries to serve these segments, it would improve equality and welfare while promoting economic growth. This issuance could also lead to growth of job opportunities within Hong Kong. In the long-term future, Singapore and Hong Kong's local banks could be severely affected in a digitally ready economy. According to James Lloyd, EY's Fintech leader for Asia Pacific, the challenger banks have potential to inflict serious damage on the incumbent banks in Hong Kong. And similarly to Singapore, local banks may be seriously damaged too. This is because incumbent banks, having not catered to these underserved segments in the past, the underserved may grow up to not only become profitable but attractive as well. And they may already have established a personal relationship with these digital-only banks, which makes it very unlikely for them to switch banks to incumbent banks, according to Chartered Yu on fintechnews.sg. In a statement made by MAS stated that they will not allow any bank, digital or not, to engage in value-destructive competition to gain market share. In this instance, having value-destructive competition means replacing an established sector that has a lot of value that causes the sector to lose its value. An example will be introducing a disruptive banking model into the financial services industry that can reduce the market share of local banks, causing the financial services industry to lose its value. A good example is the taxi industry, where Uber and Grab entered the industry, causing it to lose its value as well. If a bank gains market share through value-destructive competition, it could potentially compromise the anchoring position of local banks such as DBS and OCBC, who all own significant market shares, which can cause systematic risks. Without these anchors, Singapore could find themselves vulnerable, as emerging countries which opened their banking systems without local anchors have now found themselves vulnerable to such risks. Furthermore, these anchors are necessary as they are able to look at the big picture, which allows their interests to be in line with that of the economy as well, as they are also well regulated and diligently supervised, according to the MAS chairman. However, it must also be noted that there has been little to no evidence of value-destructive competition being the cause of bank failures, and that the primary causes of failure are the failure to manage risks and failure to diversify. Thus, even if a new digital bank engages in value-destructive competition, there is not much evidence in history supporting that the value-destructive competition will cause the local banks to lose their anchoring position or fail for that matter. In conclusion, MAS has made the decision to grant the digital banking licenses in Singapore due to a variety of reasons. One would be to solve the problems that exist, which are the lack of competition for incumbent banks, and that there still are underbanked segments within Singapore that are not catered to by the incumbent banks. It is also helpful that MAS is giving a boost by ensuring that the digital banking license will not only be able to be granted to banks with sustainable digital banking licenses, which helps solve the problems identified successfully. With the issuance, the future of the financial service industry looks bright within Singapore, as the digital banks will challenge the local incumbent banks and force each other to be more innovative in producing their digital products and services, which means better digital financial products and services for the economy, improving the economy. Furthermore, it can be seen that there are no notable evidences of banks failing due to value-destructive competition, but it may also be due to heavy regulations on that competition itself. Hence MAS' decision to prevent value-destructive competition. Thank you.